Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Gareth Ryan from IUR Capital in London. Before we get started, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just a reminder, this is for educational purposes only. So I'll stop sharing my screen and welcome back, Gareth. This is the start of a regular monthly series with you. And let's see, there you go with the presenter role. You should be able to share your desktop now.
Yeah, I'm actually just going to, while you were talking, I'm just uploading the slide. 1 second. It's in here. Yes, these ones. Okay, so that's uploading.
Okay.
All right. Okay, so we're ready?
We are.
All right. So firstly, welcome everyone. This is Gareth from IUR Capital, the presenter for today's webinar with Capital Discussions, and thanks to Tom for inviting us back. So I believe most of you are part of the regular group that join the roundtable discussions, so you are familiar with the WebEx platform. Over on the left is our cover slides. Over on the right is the chat panel. This is, of course, an interactive webinar, so you can use the chat panel at any time to send myself any questions or comments that you may have about anything that we talk about during today's webinar. Okay, so the slides are also available at the end. You can request the slides directly from myself. My email address is in the bottom left of the slide. So Tom has given you all a risk disclosure, but we also have our own risk disclosure. So here it goes. Okay. All right. So options are leveraged products that involve risk and are not suitable for all investors. Before you commit your capital to any option strategy, please ensure you've read the characteristics and risks of standardized options provided by the Options Industry Council. You can also obtain a copy of that on that link. IUR is an investment advisory firm that is registered with the Securities and Exchange Commission as an investment advisor, and also authorised and regulated by the UK Financial Conduct Authority. We do not hold any client funds. Client accounts are held at a FINRA regulated broker-dealer and clearing firm. Neither the presenter, that's myself, or IUR is a FINRA registered representative, and of course IUR is not affiliated with any broker-dealer. None of the content we discuss in this presentation carries an offer or solicitation of an offer to buy or sell any security or operate any specific strategy. Any securities included in this presentation are for illustrative purposes only and are not intended as recommendations. Execution fees for US options will vary based on broker-dealer, and of course where multi-leg strategies are discussed, that includes spreads, the execution fee is generally per leg, and therefore multiple commissions will apply. Information that we provide in this presentation is believed to be accurate, but the accuracy and completeness of the information is not guaranteed. Investors should not rely on any information for the maintenance of books and records or for tax, accounting, financial, or regulatory reporting. And of course, past performance is not indicative of future results. Okay, so all important things to bear in mind with regards to options and investing in general. Okay, so for anyone here that hasn't been to our capital discussion roundtables before, this is a brief background on myself. Folks, I'm the Managing Director here at IUR Capital. We are actually celebrating 10 years in business in 2017, and as you can see, I did previously work at a Wall Street broker-dealer in equities and options. Okay, as I mentioned also, we are an investment advisor specializing in option strategies for both retail and institutional investors. Okay, so all important things to bear in mind about myself. Now, first up, I normally like to keep our roundtables to focus specifically on strategy and the in-depth of our premium harvesting strategies, which is, of course, what we're going to talk about today. Before I get to that, what I do want to do is actually give you both an update on our 2016, a look back at 2016 performance, and of course, our year-to-date performance in 2017. So what you should see in just a brief moment is our 2016 figures. Here we go. Okay, that's just loading. It may take a second. In fact, what I may do, Tom, just to speed things up here, is bring that into a screen share. Looks like the WebEx system is a little bit slow. Okay, here we go. It's just loaded. All right, so folks, this is the 2016 performance snapshot for our core index option strategy. That's the S&P 500 index credit spread strategy. So the key figures are over on the right. You can see the cumulative return. It's a little bit grainy, but that's 50.48% for 2016 full year, and that is net of a 2.5% annual management fee, but gross of a year-end performance fee of 20%. Okay. You can also see over on the left a comparison against the benchmark. That's the SPX, of course. Green line being the SPX, blue line being the strategy performance. This performance is based almost entirely on put spread premium being harvested using both weeklies and monthlies. And of course, that's the core objective of the strategy itself, to generate premium to the portfolio using both short-dated and long-dated options on the S&P 500 index. Okay. Secondly, of course, it seeks to outperform the benchmark S&P 500 index on an annual basis, net of fees. Okay. Now, what I will do is I'm going to bring you into my my screen share so that we can also take a quick look at the year to date, because I know a lot of you have been asking us recently how we've been doing year to date. So let me just do a screen share here on the WebEx. Here we go. Okay, so you're going to see my screen in just a second. We are going to spend some time as part of this roundtable in the IB platform. But before we do that, as I mentioned, here's a quick look at 2017 year-to-date performance. So again, the key figures are over on the right. The cumulative return as of April 4 is 8.3%. And of course, that again is net of a 2.5% annual management fee, but gross of any year-end performance fee. Okay, over on the left, again, you've got your comparisons. Blue line being the strategy performance, green line being the S&P 500 index. Below this, we also include the actual brokerage account statement. So if you do want to take a look at what we've done on a year-to-date basis, there is quite a detailed trade breakdown, which I'm not going to go through with you now, but it should start on page, here we go, on page 9, okay, all the way back to January. Okay, you can of course request this performance breakdown from myself, along with the slides for today's webinar at the end. Okay, so we'll talk to you a little bit more about that a little bit later on, but let me bring you back into the WebEx so that we can get started on the slides. Andy is asking, Andy, thanks for the question. Andy is asking about our status. Are we regulated by CFTC and NFA for U.S. investors investing with us? So, Andy, we are SEC registered as an investment advisor to deal with U.S. clients, and we can deal with you from pretty much anywhere, not just in the U.S. Okay, so we are registered to deal with U.S. clients, both retail and institutional investors. Okay, and you can request more information about our status in the U.S. as a registered investment advisor with the SEC at the end of the webinar. All right? Okay, let's move on, folks. I do like to include a brief market update in all of our webinars and roundtables. So, folks, today we're about 5.5% year to date on SPX. The VIX is still near near its all-time lows of about 11. We're at about 13 today, folks, on the VIX, up about 6% after today's jobs report, which, as some of you may know, was quite a big miss for the month of March. So we had a little bit of a negative reaction today on the open in the U.S. on the back of that jobs number, but we're pretty much flat. Equity markets back in February, folks. February was a very good month overall for equity markets, as you know from SPX performance. That's despite the fact that we did have a rate hike last month in March, and we are expecting, of course, at least 2 to 3 rate hikes. This, of course, is the great debate, how many rate hikes we will get in 2017. We estimate between 2 and 3, possibly more, depending on the economic data. Okay? Oil prices and banks, of course, have contributed to this Trump rally, and that's where most of the rally has come from year to date. Folks, overall, Q1, I believe the first quarter of 2017 was the best quarter since 2015 for the S&P. But on top of that, our outlook for volatility, well, we're not looking for volatility to do anything spectacular in terms of the VIX over the coming weeks. Yes, we do have a French election, as you know, coming up in the next couple of weeks. That's pretty much about it in terms of expected volatility events, right through to the end of summer when we've got a German election coming up as well. So all the focus is on what's going on with Europe right now. Yes, of course, we've got lots going on in the U.S. government in terms of trying to get things done. And of course, tax reform is quite a big topic. It never normally is, but it is with what Trump is promising for tax reform this year. And of course, that's one of the reasons perhaps why we've had such a nice gain for the first quarter on equity markets. So a lot of that being factored in. Okay, so opportunities for 2017. We're talking about premium harvesting because, of course, that's really what we do here at IUR on a daily basis, seeking to generate premium to portfolios using index options. So opportunities for this year. Well, before we get to this year, last year's opportunities, as you will see on my charts in the next few slides, really there were only 3 opportunities to take advantage of by the dip in 2016, and you'll see that on the charts. Most of you know what I'm talking about with regards to 2016 price action. But between those volatility events, we had prolonged periods last year where realized vol was near all-time lows. I'm talking about daily realized vols of maybe 2 or 3 points or more, perhaps a little bit more on SPX. And that does play to the advantage of some option strategies, but to the disadvantage of others. All of you should be familiar with neutral option strategies like the Iron Condor as an income seeker for the portfolio. Iron Condors during the period of late June all the way through to early September, that would have been perfect market conditions for weekly Iron Condors on the RUT or an SPX or Spider or any of those other big index products out there that focus on harvesting premium using very near-term time horizons. That's the period last year which really stuck out for us in terms of using very near-term option strategies where you are seeking to generate premium with a neutral outlook for the underlying index. Of course, we had a little bit of a spike in early September of last year, and then we had another period of several weeks where realized vol, which is what we look at a lot here at IUR, remained almost at all-time lows, both realized vol and implied vols. Directional opportunities, well, they were less frequent last year, as I mentioned. 2 or 3 real directional opportunities at most last year. Premium generation really is what should have stuck out for 2016 in terms of being a net seller of premium on those indexes. Of course, if you are an option buyer, folks, that means you're a gamma buyer. And if you're not getting a move in the delta, then you're not getting a move on the gamma in terms of being a call or put buyer. That's why the whole concept of in buying options in general has become less attractive for option strategies and for anyone here dealing in options, particularly in this low vol environment. Of course, it's not going to last forever. It has lasted for several years now, but at some point, folks, we are going to break out of this volatility environment where we're sitting near all-time lows. And that's, of course, where things will get interesting for volatility strategies. Okay? Okay, so a couple of charts to get through with all of you because it's always good to get some perspective. This is the 1 year in SPX. So what are we looking at here? Well, you can see we've got some peaks and troughs on the index. Apart from this, this is the Brexit sell-off over on the left. That's, of course, when we had quite a sharp move to the downside on SPX. But apart from that, where are the opportunities? Well, as I mentioned, in the middle of the screen, the middle of the chart, that's all sideways action for SPX. And there are 4 option strategies that are neutral or relatively neutral in outlook, should have benefited the most during the entire summer period of 2016. As I mentioned, there was a slight pullback and some weakness after everyone came back in early September. But after that, it was all upside movement, both during the presidential election and afterwards. Of course, the majority of the returns for last year were generated in the final few weeks of 2016. Okay, so lots of sideways action, both with regards to SPX, but also on other index products as well. This is probably a better chart for us to look at when it comes to looking at volatility. So this is implied versus realized, blue line being the implied, the white being the realized. As you can see, implied is almost permanently far above realized, but there are some periods where they do narrow realized and implied. As you can see, throughout most of summer last year, we were very low in terms of realized vols. Implied vol also was dragging lower throughout summer. We had a pickup during late October going into the elections. But of course we sold off, and we continued to sell off in terms of implied vol going into year end as the market rallied. So where are we now, everyone? Well, we're pretty much near, not at the lows here, but we're pretty much at the lows in terms of realized vols. Remember how realized vol matters for you with regards to option strategies. It tells you what we're actually seeing in terms of daily point moves on SPX. Implied vol is important because, of course, volatility is what drives option prices, but it's always a good idea to keep an eye on what realized vols are doing, okay? Okay, so a couple of scenarios. Most of you are retail investors listening into this webinar, and we do include these next couple of slides in most of our presentations because it does give us some scenarios to work with. Not all of you will fit into one of these 2 scenarios, but most of you will. Scenario 1, most likely you're sitting with a 6-figure portfolio that's either being self-managed or by someone else in the 40 to 60 age range with little or no dependence. It's like you've got some kind of income through with your own financial circumstances, but you've also got the objective to increase your income through this portfolio. It's likely you've got some kind of traditional structure to the portfolio, so bonds, mutual funds, and some dividend-paying components in there. It's also likely you've benefited modestly from this 5 or 6% gain during early 2017. But I can tell you that we're not looking for SPX to continue this price action throughout 2017. It's likely that we will get some sideways action, and in fact, as you probably see in the past few weeks, we have started to level off and meet some larger resistance on equity markets. Getting back to this scenario, you are, of course, looking to generate consistent income to the portfolio, but you're also looking to focus on capital preservation, okay, because this is generally our retirement portfolio. In this case, you would be willing to allocate 15 to 20%, perhaps at most 20%, of the overall portfolio to an option strategy that seeks to generate premium on a consistent basis, but without excessive risk being taken. Okay, you're looking to achieve a regular premium, even if we are starting to see flat market conditions or even possibly a correction, which is perhaps long overdue for equity indexes. That's scenario 1. Scenario 2 is something similar, albeit in an IRA, okay, for anyone listening in the US. It's likely you're either in retirement or nearing retirement with no dependence. Okay, income has dropped, but of course you're wary of expenses that have to be met with regards to either one or more of your retirement accounts. Most likely you are again invested in some bonds with an exposure to dividend paying components. But that dividend income is most likely nowhere near what your requirements are to meet regular drawdowns. Again, you are focused on preserving your capital in the retirement account, okay? But you are willing to consider an income generating strategy using options that does not require a continually rising market. Okay, and this is where we're going to talk about the credit spread strategy during today's event. So we like to split our option strategies between the left and the right. Of course, there are a plethora of option strategies out there. We're going to focus on the credit spread in particular on the left side of this table. Remember, if you're taking volatility-based strategies, it's either going to be as a buyer of options, a call or put buyer, or something a bit more complex, perhaps a long straddle or a long strangle. Premium harvesting is focused around the call overriding strategy, the credit spread, and of course a supplement of iron condor or butterfly strategies. All of those are considered traditional income seeking or premium harvesting strategies for us here at IUR. We're going to focus on the credit spread, as I mentioned, during today's event. Some things to bear in mind about the credit spread, of course. All of you who are dealing in credit spreads for your own portfolio at the moment will know what I'm referring to with regards to time decay, direction of the underlying, and volatility. All of these are things that you need to focus on with regards to the credit spread strategy as such. But in particular, time decay, for anyone here dealing in weeklies, folks, as you all know, we've had even more availability now with regards to weeklies in the past year or so. Last September, the S&P 500 index options and SPDR, both of those now have mid-weekly. So on top of what we originally had, which is the traditional monthlies and the Friday weeklies, of course we now also have the mid-weeklies. So your opportunity and the number of opportunities that you have in any given month is simply getting greater. So now in any given month, you could have both two weeklies and the monthly. Okay, that means on those index options, most likely you have 7, 8, 9, or even 10 opportunities in any given month to sell premium or buy premium for that expiry. Okay, anyone dealing within a 30-day time horizon, of course your attention will be focused on those mid-weeklies and the weeklies. All right. As you'll see when we get to the credit spread strategy, we're focusing on a couple of things here, not just the near-term time horizon. Now, there is some kind of path dependency to what we do here at IUR in terms of premium harvesting. These four things matter to us when it comes to running a premium harvesting strategy on an index. Okay, so first and foremost, market conditions, which forms part of the overall macro picture for us. Yes, we do split our approach between fundamental and technical, but I can tell you I put a lot more weight on the macro picture than anything else. The S&P, of course, is a reflection not just of U.S. macro but global macro for us, and that's what we like to focus on with regards to market conditions. Where are we right now with market conditions? Well, things have admittedly been very sanguine. That word sanguine is appropriate for the past few weeks. After February's rally, we started to hit a roadblock in terms of moves to the upside. As I mentioned, we are north of 5% year-to-date for SPX. Our outlook for SPX in terms of market conditions for the rest of 2017, I would be very surprised if SPX does more than 15% for 2017. Okay, and that's of course assuming that the U.S. government, the Trump administration, lives up to its promises with regards to tax reform. It certainly didn't meet its promises with regards to the Affordable Care Act, and the market did get into a little bit of a tizzy about that during March, but we're more hopeful of other things being done which are being priced into current market conditions and expectations for the rest of 2017. Okay, market conditions also includes volatility. Okay, we have to look at where the volatility is going to come from. Pockets of volatility will appear over the coming months. We can be sure about that, folks, because volatility never stays in one place. It's a dynamic instrument. It's quite a dynamic force, actually, in regards to options implied volatility. So where is that going to come from? Well, as I mentioned, we've got some geopolitical things coming up in the next few months, which will matter on top of what's going on with the rate cycle for the Fed funds futures. Okay, strike selection. Well, again, this kind of plays back into the macro picture. There may be certain cases, folks, where harvesting premium should only be done on a near term. If you're looking out on the time horizon, which is number 4 on this, if you're going out 60 or 90 days, well, of course, strike selection can be positioned much further out of the money as a seller of premium. That's quite obvious. But if you're focused on keeping your time risk to a minimum, let's say within 30 days, well, of course, strike selection has to carry with it a higher delta exposure as a seller of premium on those indexes. That generally means that, for example, on SPX or SPDR, if you're running a weekly premium strategy, being within, let's say, 2 to 4% of out of the money, that could be considered your range as a seller of premium. Okay, now, of course, that means you do carry perhaps something north of a 20 delta exposure on those weeklies, but that's the risk that you're taking. That's the risk that you are acquiring in order to generate enough premium to make it worthwhile. Of course, the decision of whether to hedge that delta exposure is up to you and to what extent. We're going to talk about that hedging approach with regards to weeklies when we bring you into the platform. But that's an important point about strike selection. Underlying security, well, for anyone here that knows what we do at IUR, we're not really here to be a stock picker as such. Yes, we do run equity portfolios for clients, but our focus is generally, with regards to option strategies, on a basket of underlying securities. And that basket is generally less than 10 names. In fact, in most cases, less than 5 names. We're focusing on index products, okay, big index products that have a lot of liquidity, which carry very little cost for us in terms of adjusting positions when required. Time horizon, well, as I mentioned, I talk about strike selection and how it kind of relates to time horizon. The great thing, of course, about index options, everyone, is that you can set your own time horizon with regards to what your expectations are for the market over that period. With the advent of these weeklies and now the mid-weeklies, the issue that you have generally with the options market is the introduction of short-termism for retail investors who are simply more focused and more attracted to keeping time risk to a minimum, and therefore focusing on the very near term, despite the fact that they are trading with higher delta exposure when selling premium. So that's an important point to bear in mind for everyone here running weekly strategies. Okay? All right, now let's get to the details of the 1x3. Anyone here that has come to our webinars before, this should be a summary of what we talked about previously, but we're going to talk about this in real market terms in the platform. Anyone that's new here, it's a very simple explanation. 3 put spreads sold out of the money, 1 put spread bought at the money or close to at the money. It's either established at 0 capital outlay or small net debit. Okay, opening net debit. Objective is very simple: to extract your credit upon the sale of the hedge when it is sold at some point before the expiry. The approach for the 1x3 will differ based on the weeklies and the monthlies. Okay, on the monthlies, what you can normally find is that you're sitting much further out of the money, away from the action, away from the vega or the at the money volatility, but you are taking a bigger time horizon. Yes, you're bringing in a higher credit, but your time horizon is longer, and therefore you do need to manage that time risk to be a seller of premium. Okay, I'm going to bring you into the platform in just a moment so you can see exactly what this looks like. But it's important to bear in mind that the 1x3 can be used on pretty much any product that has liquid index options. And remember, it can be used on either the put spread or on the call spread side. Okay, now let's bring you into the platform so we can see exactly what this looks like with regards to current market conditions and what we're doing for our clients with this 1x3. So my screen share will appear anytime now. Okay, here we go. All right, so this is the, for anyone that's not familiar with the ID platform, this is the Interactive Brokers Option Trader window. Okay, what you've got here is all of our tabs along the top with regards to our positions that we're looking at. on these products. So SPX and Spider, that's what we're going to focus on with regards to this particular event. So what you've got is all of these are April expiry. That's the important point to bear in mind with regards to time horizon. And the open market positions, the bid and offer, and of course position sizing as well. So open positions, short put spreads are of course in red, long put spread positions are displayed in the green. So what do you notice first and foremost about this? Well, you can see we're short a lot more premium than we are long as we approach April 21 expiry. Okay. I can tell you that we do have some hedge remaining for April 21. But if you take a look firstly at what our short put spreads are. So basically our largest position here for our client accounts is 223, 228 put spread. Okay, so we're short that more than 1,000 contracts. Okay, opening credit was about 30 cents. It's now trading at 20. Spider today is around 235. So we are still about $7 out of the money with regards to the position. Where are we with expiry? Well, we're 14 days to expiry on that position. We are looking good on that, and also on the other two positions, which is April 21, the 3.5, 8.5, and the April 13, 5.5, 30.5. That's 225 half, 230 half. So both of those are moving towards expiry nicely. FPX, as you can see here, around 23.56. The range that we're in right now, we're pretty comfortable with it. What about the hedge? Well, folks, I can tell you this hedge was originally a 1/3, which means that we were short 3 times as many of these as we are long of these. But we have modestly reduced that hedge in the past couple of days. It's likely we will carry that position through to the expiry week. Bear in mind, folks, next week is a short week, 4-day trading week next week, and then the following week is expiry week. But what about our credits and our debits? Well, as I mentioned, we opened at about 30-cent credit here. So for every 3 sold, of course, of those, we know that our opening premium being received is about a 90-cent credit. But our hedge is costing us about $1.10, I believe. So we're paying out $1.10, and of course bringing in at 90. So we're opening up at about a net credit of 20 cents. Okay. The objective then is simple. Your break even is 20 cents. The objective is simply to sell that credit, that hedge, for more than the break even of 20 cents. Of course, the higher the better with regards to premium. Where are we right now? Well, 229, 234 is the strikes. Both legs are still out of the money, but the 234 long leg is pretty much, well, it's about $1.20 out of the money. So we are looking to participate more to the downside with regards to that position on the 229, 234. That's the hedge. That's the only hedge we have right now. But as I mentioned, for April expiry, April 21 expiry, we are looking good with regards to premium on the 229, 234 and 223, 228s. Okay. Now, this actually, it is a 1/3 scenario, as I mentioned. If you have any questions on that, you can let me know in the chat panel. Okay, but generally what we're looking to do here is, as I mentioned, extract that credit where the position is, well, the hedge in this case is either at cost basis or it's declined modestly, but enough for us to extract the credit overall. Okay. The whole concept here, as I mentioned, is always to be extracting your credit on the position before the expiry, whilst those short put spreads expire out of the money. One question I always get actually is, well, what happens if the market does fall below your hedge and it starts falling below your short put leg on that put spread? Well, folks, that's where you get to move to the left on the graph that I was talking about earlier, and this is where the adjustment takes place. The adjustment, of course, is generally a roll down of the short put spreads at 223, 220, 228, whilst continuing to hold the hedge. Remember, these are both $5 spreads here, folks. Okay, and that's important to actively manage the position. Active management of the position generally means that you're, of course, monitoring both positions daily and making sure that you are still extracting a credit upon the sale of that hedge. Okay. So that's an important thing about what we're doing here. Now, here we are, April 7. As I mentioned, we've got the French elections coming up. Let's say we did want to go out to the April 31. Okay, in fact, April 28 is the last expiry. If we were taking a new 1x3 setup, how would we go about that? Well, let's take a look here at something like the 229, 224 put spread, and we want to be a seller of that on the April 28 expiry. Here we go. So our opening credit in this case, well, actually, that's quite high, 45 cents. Most likely, that's the market pricing in a big move on the on the French election outcome. Perhaps we can go a bit lower, maybe 223, 228. That would be a better example of a credit that's appropriate relative to the hedge. So here we go. That 223, 228 put spread, April 28 expiry. We do hold the same position, but for our nearer expiry. So 39 cents is a possible credit on that. What about the hedge? Well, folks, we're generally hedging pretty close to where our short put leg is. That means that perhaps 229, 234 could be considered a hedge on this case for the April 28 expiry. Here we go. 229. Okay, so the cost on this will be about $1. Now, this is the structure for April 28, okay, that we could consider. So you want to be a seller of the 223, 228 put spread. You could set 39 cents as your target, which means you're bringing in about $1.17 for every 3 put spreads sold, but you're paying out around $1 for the hedge. So in that case, it's very simple. Where will your opening net debit be? It's going to be the credit received less the hedge, which would be 17 cents. Okay, you can round that up if you like to 20 cents to factor in commissions. But that's basically where your opening net debit will be. Objective is very simple from that point onwards, to manage both positions, bring both together to the expiry, and then extract your credit upon the sale of that hedge. Okay? That's a very simple explanation of the approach. This is what we're going to be focusing on in neutral market conditions over the coming weeks. But we may also consider moving to the traditional monthlies, going out 60 or 90 days, if market conditions are going to change significantly. Okay, particularly after, as I mentioned, the French elections. Okay, so that's the 1x3 on those weeklies and monthlies, particularly on those weeklies for the near-term time horizon. Some important points about the credit spread overall, as you can see on the slide here. Really, we're there to generate income consistently. If the underlying security price is, of course, above our strikes on the put spread. Opposite on the call spread, of course. Credit spreads are always established at one transaction, but at a net credit. Okay, and of course, we have a preference to do this on those index products, SPX and Spider in particular. Max loss, of course, will generally occur on the credit spread where you are holding the position when the underlying security is below the higher leg, the short leg. A general rule we have here, folks, is that we never let the position get in the money. Okay, for a seller premium on a put spread or a call spread, you really should be adjusting. If you are doing this on a systematic level or a rules-based level, you really should be adjusting before you get in the money with regards to your positions as a seller premium. That's to keep your buyback cost to a minimum. Adjustment costs have to be contained, and that means you have to be adjusting before it becomes a problem. Okay, the old phrase for option sellers is never let small delta become big delta, and that's very important to bear in mind as a net seller of premium. For someone running a premium harvesting strategy like the credit spread. Okay, Ted is asking, what do we do in a fast market of, let's say, a 5% drop in Spider? Well, of course, folks, we're doing this on a daily basis. Okay, we're managing positions intraday from market open to market close, and we also have to consider our overnight risk. Okay, overnight risk actually for us is more important because, of course, the nature of the S&P is that you've got the futures trading overnight. The next morning they will, of course, give you an indicative opening for SPX. With those weeklies, and this is where the greatest risk presents itself in regards to weeklies, that you are generally within 5% of at the money. In fact, some cases within 3% of at the money. And that's where the necessity to hedge comes into play, and more importantly, the size of your hedging. A 1x3 put spread strategy does still carry downside exposure. You are still short skew, okay, as they say, but you have less excessive negative skew than if you were an outright put seller or even just an outright put spread seller. Because in that case, you have a lot more downside exposure as a seller of premium. The 1/3 is there, as I mentioned, on this particular graph. Here we go. This particular graph, folks, shows you that we are actually seeking to participate in a modest downside move, in this example, of up to about 5.5%. This is on a traditional monthly setup, not on a weekly. Okay, just bear that in mind. But that gives you an idea of what our approach will be in this case. It's really there for the traditional monthlies. The weeklies will have a much narrower range and therefore a higher gamma exposure as a seller of premium outright. But what do we do, of course, if we have a sudden market reaction to the downside and we are holding weeklies? Well, of course, that's where moving the left side of the graph even further to the left is done through the adjustment of a roll down. That means buying back the existing put spread, seeking to recover, if not all, the majority of your buyback cost. Meanwhile, your hedge continues to move in the money, and therefore you have that unrealized gain on the hedge. Okay, so that's the active management part of the position, Tom. Okay, Tom was also asking, are you assuming that we make more than on occasionally a 5% drop? Well, as I mentioned, Tom, we are actually seeking, with a 1/3 on the put spread side, you are seeking to participate and benefit in a modest pullback. It's not really designed for a market that's continuing to move to the upside. If that was the outlook, of course, we wouldn't have a hedge. We would simply sell put spread premium on a continuous basis. Okay? Okay, so a couple of other points just to wrap up here, then I'll open it up to the floor for everyone. With regards to 2017, some of you actually do have quite a structured plan in terms of premium harvesting, and I've been quite impressed with some of our clients and what they do in terms of a plan for monthly premium for their portfolio. You should never really allow one particular event or price move to impact your portfolio. The Affordable Care Act, that vote that never was a vote, that went to the floor 2 Fridays ago, which actually got pulled at the very last moment. The market reaction in that, we saw significant gaps both in the Dow and the S&P, as you know, on that Friday afternoon. We had the Dow rallying in the morning, then selling off in the afternoon, and then closing down slightly. Of course, the following Monday, you had a larger open to the downside. The Dow sold off 180, and the SPX was touching the 2320 level. That reaction is more of a binary event, but binary events like that can impact your portfolio more than you would really like to, and that's where you really need to manage your binary event risk. Okay, it's simply event risk. There will be other events like that, folks, as I mentioned, during the rest of the year that you really should be focusing on, because they can have they have enough powder in them to basically impact your portfolio more than you'd like to. Hedging, of course, always comes at a cost, but just like car insurance, you never really know you need it until you actually need it. Okay, and when you don't have it, that's where your downside exposure can become significant. So always remember that it's better to be consistently making smaller amounts of premium than seeking to generate one large tranche of premium to make up on a previous loss. That's where you probably get more aggressive than you really need to be. Also bear in mind, folks, as I mentioned, with the advent of the mid-weeklies and the weeklies, you've got even more opportunities to recover from any previous adjustments where you did have to realize a near-term loss. Okay, earnings, folks, coming up next week for Q1. That will present some risk in terms of company-specific risk for anyone here that is doing running an option strategy in one or more underlying name that you may hold for your portfolio. Okay, we generally like to avoid earnings risk with individual names, and of course, by focusing on indexes, everyone, we can mitigate some of the company-specific risk around earnings. Okay, as I also mentioned, monthly objectives. A lot of our clients that we work with regards to premium harvesting, they are based around their own objectives for what they're trying to do for their portfolio. If I bring you back briefly to last year's return, as I mentioned, that's the 2016 performance for the S&P 500 index strategy. Folks, last year we continually hedged, okay? So although we were up significantly for the year, the hedge did drag on the returns. And we're going to continue to hedge in 2017 using something like the 1/3 or a similar ratio. Even if you are losing money on the hedge, folks, provided that you are continually extracting net premium each month, then really that should be meeting many of your objectives, at least one of your objectives of continuous growth to the portfolio overall. So that's 2016, folks, as I mentioned. 2017, we've had a reasonably solid start to the year with regards to performance on the credit spread strategy. But as I mentioned, we are also going to continue to hedge any short premium, particularly on the weeklies. Okay? Now, Ted is asking again, are there certain market conditions you would not put this trade on, like a bear market where the market keeps creeping down? Well, Tom, that's a good question. Sorry, Ted. Ted, that's a good question. Bear in mind, everyone, that credit spread strategy is there for both bull markets and bear markets. If we really thought that a significant correction was on the horizon, well, folks, that's where the call spreads come in. Instead of focusing on the put spread premium, we'd switch over to the call spread side and simply run a similar strategy. I can tell you that last year, as I mentioned, with those 2016 performance figures, a small portion of the premium was generated on the call spread side, but the vast majority of the premium was harvested on the put spread side. Okay. And one other important point: year to date, most of the premium has been generated on the put spread side as well. Okay. Okay, so folks, I've talked a lot about what we do here with the core index option strategy. This is really how it all works in terms of how we work with retail investors out there on the Interactive Brokers platform. As I mentioned, we deal with both retail clients and quite large institutional clients. All of them can run this strategy in one or more portfolios. It really is there, the concept of premium harvesting, it's really there to generate a consistent income. It's not designed to be an aggressive directional option strategy. Okay, we're not looking to put the ball out of the park every single time with the credit spread. Instead, it's about generating that consistent income, which of course generally meets another objective of capital growth to the portfolio. So this is how we work with you on the option advisory side. We also have a managed options account, both available on the Interactive Brokers platform. You can request more info about the strategy that we've talked about today and the option advisor account by reaching myself directly on that email address on the screen. Okay, I know a lot of you have questions, more specific questions about the strategy and how we operate this based on market conditions. I'm very happy to talk to any of you individually on a one-to-one basis after today's roundtable. Okay, and of course you can request the slides for today's webinar and that performance info for 2016 and 2017 year to date by getting in touch with me on that email address. Okay. Andy is asking with regards to the year-to-date net asset value. Andy, just to bear in mind, what we're looking at here with regards to year-to-date, let me just bring you back into the year-to-date performance if I do a screen share with you very briefly. So this is the 2017 year-to-date performance of the S&P 500 Index Credit Spread Strategy. The net asset value that you see here, let me just clarify that, over on the right. This is basically our proprietary trading account. We run the strategy not just for clients, everyone. We also run it for the firm as well in a prop account. So this is purely one account that focuses on one thing only. It runs this S&P 500 Index Credit Spread Strategy on the account itself in Interactive Brokers. As the performance or as the strategy continues to perform, we at IUR will of course continue to allocate further funds, for firm funds, to the strategy. Okay. Again, Andy, you can request this and the actual account statement underneath. You can request that from myself after as well. Okay, I'll bring you back into the platform. Andy, you can perhaps reach out to me after today's webinar. I'd love to have a chat with you about the performance in more detail. In the meantime, everyone, as I mentioned, you can request the slides and that performance info from myself on that email address on screen. And in the meantime, I'll pass it back to Tom, and I'll look forward to speaking with you all very soon.
Okay, well, I don't see any other questions after Andy, but I think you'll talk to him one-on-one if he has more questions. Really appreciate Gareth. I know I kind of messed up the time. You wanted to go a little bit later. Sorry, it was a little bit earlier, but I just did the math backwards. Sorry. But thanks again for presenting. It's always good to have you back, and we'll have you every month. So first Thursday in May, we'll have you back. So thanks again for presenting. Really appreciate your time.
Okay, great. And I'll speak to you all very soon, folks.
Okay, thanks everyone.